Well, hi everyone, and a very warm welcome to this Oakland's webinar entitled Exit with Excellence, the Foundations of a Successful Company Sale. I'm Peter Gray, the chairman of Oakland's based here in London. So just by way of introduction to Oakland's, for those of you who don't know us already, I know many of you will, we're the world's most experienced M&A and corporate finance advisors in the mid-market. We've got fantastic global reach with representation in around 40 countries, strong regional representation across Europe, Asia, the US, and LATAM. And that international presence enables us to provide a truly global service for our clients, whether that involves sourcing overseas buyers on a sell-side mandate or assisting our clients with finding acquisition targets to meet their global expansion plans. In terms of our track record, we collectively close around 400 deals a year. And on average, at least a quarter of those deals are cross-border transactions. Now, in addition to selling companies, we advise our clients on how to prepare their businesses for sale, both to maximize value, but also, and just as importantly, to make sure a deal actually happens. And today's webinar is part of a series of seminars that we're holding on planning an exit. And today we're talking about how to choose the best time to sell your company. Personally, I think timing is perhaps the biggest value driver in the context of a company sale. If you get the timing right, you can maximize value. If you get it wrong, you can completely destroy value. So a lot to play for in terms of getting the timing right. We've got a great panel today from Oakland's, comprising Oakland's members across the globe. And let's kick off by asking each member of the panel to introduce themselves, starting with Jürg.
Thank you, Peter. Jürg Stucker, partner Oakland, Switzerland. As you can hear from my accent, I'm a member of the executive committee of Oakland's International and in M&A for 20 years. That sums up to about 250 projects in M&A and corporate finance.
My name is Florian von Alten. I'm managing partner of Oakland's in Germany. I've been with the company 29 years, and I have a lot of experience in cross-border M&A transactions.
I am Priscila, Rosas, partner at Alten Brazil. I've been working with M&A for 15 years, and it's a pleasure to participate with all of you in this webinar.
My name is Don Wiggins. I'm the Oakland's office in Jacksonville, Florida in the US. Our company has been a part of Oakland's since 1985 and the founding, and I've been with the company 34 years and handling transactions and have been very active with the Oakland's organization. I've been chairman once and treasurer twice, and it's a great resource to have access to.
Fantastic, thanks everyone. So Jürg, first question to you. When is the best time to sell a company? Let's cut to the chase.
Yeah, the question can be answered basically on three different levels. There's a macroeconomic level, the sector level, and there's the company, or let's call it the personal level also, that is relevant. The most relevant of these three is probably the company level. But let's start first with the macro level. We had a very good environment for exit transaction over the last decade. Low interest rates, lending to advantage debt market, especially important for financial investors. A lot of money was looking for yield. We had innovation, global trade, fundamentally optimistic expectations for the future. The pandemic and also the deterioration of the geopolitical situation, inflation, higher interest rate, have now somewhat worsened the exit climate. We are seeing this in transactions. Financial investors, they are still hungry, but some face pressure to do deals. But the deals with them has become a bit more uncertain, but strategic investors are still there. That's on the macroeconomic level. On the sector, which is more important than the macroeconomic environment finally for an exit, If your sector is performing well, if there is growth and some players are trying to consolidate the sector, this has a highly positive impact on the exit environment. However, as I said at the beginning, the most important perspective is the company level or the personal level. At a personal level, situations can arise where it is just the optimal time to sell. For example, if you are planning to retire, to relocate, or to pursue other opportunities, it just might be the right time to sell. Long-term personal or financial objectives and how selling the business aligns with them may also play, of course, a role. At a company level, I'd say the best time to sell is generally when you have 2-3 good years in the books with a solid track record of revenue growth, profitability, when you achieved your budget, and when there are credible prospects for future growth. The more future sales are already secured, for example, through existing orders or framework agreements, the better. Ideally, the company is also prepared for a sale in all aspects. We discussed them in our last webinar, preparing for an exit, such as having a strong management team in place, reducing employee and customer dependencies, eliminating risks, and so on. Usually it's not a single aspect that triggers the decision to sell, and it's of course difficult to sell business exactly at the best time.
Fantastic, thanks, Jürg. Next question, Florian. Florian, why are companies not always sold at the optimal point in time?
Peter, I think that is a very interesting question. Selling a company is a very challenging and time-consuming process. But like buying stocks at the stock exchange, it is very difficult and almost impossible to buy stocks at the stock exchange ex ante at the optimal point of time. You will most of the time only imagine if it was the optimal point of time after a certain period of time. Nevertheless, what are the major influences on a good timing of the process? Like Jürg just mentioned, the macroeconomic conditions have a huge impact on valuation and the overall interest of potential buyers. A positive market outlook and high stock prices do increase appetite of bidders. Furthermore, a more aggressive or more positive business plan is more likely to be accepted in an auction process by many bidders and thus leading to higher purchase price. However, an optimal timing can also be distracted, for instance, by exogenous shocks. Just imagine the Lehman crisis in 2008, where many industries had a sudden drop of revenues and profitability by 40–50%, or the pandemic of COVID-19, or even the Russian war in Ukraine, which have an immediate impact on optimal timing of the sale of a company. Then look at disruptive technologies or a change in consumer preferences, which can have a big influence whether somebody is interested in a business or not. For instance, the European Community forbade the sale of plastic drinking straws. It's a niche market, but if you are one of the major suppliers and you are not allowed to distribute those products in Europe anymore, there will be hardly any interest in that. Or imagine you have a component manufacturer for turbochargers in diesel engines. It will be very difficult to find attractive valuations in this market environment when everybody is talking about electromobility and the end of the combustion engine. Fourth issue are personal circumstances. We sell a lot of privately owned companies, and in many cases there is not only one decision maker but several, and as private owners are not very experienced in M&A transactions, some of their decision processes are taking long, maybe even too long. That also accounts for preparing a data room And this overall could lead that an M&A transaction will last much longer than accepted or envisaged by bidders. And this will lead maybe to the fact that some bidders drop out on one hand. On the other hand, that the sale of your business is becoming more transparent to lenders, to suppliers, competitors, or employees as information are leaked. Therefore, it is also in the interest of a seller that a process is professionally managed and that the timing between going to market and closing a transaction does not last too long. A last point, which is important, is change of legal or tax regulations. We've seen that in many countries around the world, that suddenly governments change the tax benefits on the sale of companies. And if you are not well prepared for a process, you might have to hurry and sell a company before end of the year in order to still save those tax benefits. Otherwise, you might end up with paying higher taxes on the sale of your business. Overall, I think it is a process which is complex. It's not just about a certain industry. You have to take overall macroeconomic and political environment into your consideration and find the best timing for your acquisition or your purchase, sale of the company. But in the end, you will only know maybe after a year or two whether it was really an optimal timing or not.
Brilliant. Thank you, Florian. Priscila, next question to you. What are the various exit options available to entrepreneurs looking to sell or defloat? Answering my own question, their businesses.
Thank you, Peter. So I'll talk about three main exit options for business owners and the different implications and outcomes they have. I will start with a trade sale. On a trade sale, the acquiring company is usually looking to increase market share, access new markets, products, new technologies, or to achieve other strategic objectives, such as vertical integration or diversification. Strategic buyers tend to focus on what the company could be worth in their hands, considering all the synergies and strategic advantages the acquisition can bring to them. So they are willing to pay higher valuations. In this type of transaction, the business owner can exit completely of the business and be entirely cashed out at day one. In some cases, a trade sale may have an earn-out component if the business has areas that are still yet to be proven, or if the seller and the buyer have different expectations about the future performance of the business. In this case, the earn-out can help to bridge the gap between them. Also, if the owner is considered to be key for the operation, he or she may also be required to stay for some period of time post-transaction. The second exit options that I'm going to talk about is the sale of a minority or a controlling stake to a private equity fund. Private equity deals are good options for companies that are looking for capital to fund growth initiatives, improve governance, and general strategic guidance. In a minority private equity deal, the focus is to raise capital for business and may involve a limited cash out for the seller. The business owner remains ahead of the business, and the private equity will normally participate at the board level. This is a partial de-risking option. On a controlling stake sale to a private equity, the seller transfers control of the business and voting rights for a significantly higher cash out. In this case, the private equity brings operational expertise, normally through a management team, and the business owner normally remains involved through board representation. This is an option to more de-risk for a more relevant liquidity event, but retain some upside on the private equity's investment phase. While strategic buyers look to acquire a company as part of the long-term growth strategy, a private equity fund has a shorter investment time frame, usually from 3 to 8 years. So after this investment period, private equity funds will look to exit the investment through a trade sale, an IPO, or another form of liquidity event. So the business owners may have to wait until the fund exits the investment to fully monetize their stakes. In terms of valuation, given the nature of a private equity fund, their main objective is to make their investments at a lower valuation to maximize their return when they exit. So by the time, all the shareholders will benefit from the increased valuation and can cash out completely from the business. The last exit options I'm going to talk about is the IPO, the initial public offering that involves taking the company public. This is an option for more larger companies and mature. The company can use the proceeds to fund growth and expansion, pay off debt, or invest in other opportunities such as M&A, for example. This type of exit is usually a more complex alternative given all the regulatory requirements, and also it's entirely dependent on market liquidity, no matter how well positioned the company is. In terms of liquidity for the owner, an IPO can provide a limited cash out given they are expected to remain with a relevant share after the company goes public, and the owner's ability to sell shares may be limited to lockup period or other regulatory restrictions. So this type of exit can provide a high valuation for the company, but valuations after the IPO can be affected by many external factors that are beyond the company's control, such as overall market conditions, interest rates, and performance of comparable companies, for example. So these are the three main exit options, and it's really common for business owners to want to test more than one option and pursue different routes in parallel. I think Don will talk more about that.
Brilliant, thanks, Priscilla. So Don, over to you. At what stage should you choose your exit route, and can different routes be pursued in parallel, to Priscilla's last point?
The answer to the first question, Peter, is prepare as early as possible. One of the things that we've seen, I've been doing this for 34 years, and I've seen that the earlier owners start to prepare their company to sell, the better the result is, almost across the board. And as Priscilla said, most of our transactions that we see, almost all of them, are either what she called trade sale, which also we call a strategic sale to a industry buyer. The second is to a financial buyer like a private equity group or a family limited partnership. So you cannot start too early to plan to sell. On some of the other options that she mentioned, there are also some internal options which we don't get involved with, in like selling to employees, selling to owners, to other owners or management, passing down to family. Those you make that decision fairly early that you're going to do that to prepare for it for management. But we very seldom work on those types of situations. Much more likely to sell to an external buyer like a trade buyer or a family limited partnership or private equity group. If you're going to do an IPO, which again is a very small number of the transactions we do, you need to start that process very early because there are a lot of legal implications and preparations that have to be done. The good thing is, for the types of transactions we normally see, you can make that decision very late. In fact, you can run in parallel. When we take a company to market, we will approach both trade buyers, those in the industry, and financial buyers, PE groups and family offices. And in practical terms of running a process in a transaction, those buyers really fit in the same category. We can have both of those types of buyers involved in the process up until the very last, and our client can make the decision essentially at the very end of the process. The final two buyers, for example, could be one trade and one private equity group. And at that point, when it's time to pick a final candidate, the client, our client, the owner, can make that decision. Another point I want to make is there's no substitute for running a thorough process. And I will end my answer here with one very quick story and anecdote from a situation we saw several years ago. We were asked to talk with an owner of a company who was already talking to a private equity group about buying his company. They had tentatively circled around a 6 times multiple of what's commonly called EBITDA, or operating cash flow. EBITDA is earnings before interest, taxes, depreciation, and amortization. I'm sure everybody's familiar with that term. So they had tentatively settled on a 6 multiple. Their lawyer introduced us to them. We made a proposal to them. They decided to go to market, and we approached something like 300 different buyers. Long story short, we wintered the process down, picked the best buyers down to 12, 5. And at the end of the process, the original private equity group they were talking to bought the company. The same one they were already talking to at a multiple of 6 bought the company for a multiple of 10.2. So a 70% increase in the value they received by going through the process. And the reason that they were able to do that is they were prepared for the process. And they made that decision very late. They could have sold to an industry buyer, but you can make, as an owner, you can make the decision, a lot of decisions late in the process. The key is you want to keep your options open as long as you can keep them open.
Brilliant. Thank you, Don. So in terms of some questions that have come through, we've got a question. Give me an example of a situation where a company that you've been involved in, one of your clients, has sold at exactly the right time. Jürg, why don't you take this one?
Yeah, as I said, it's always difficult to sell a company exactly at the right time. We had probably such a case a bit more than a year ago. We sold a web hosting company where timing was probably right. We had been preparing for the sale for some time, and we intended to go to market in 6 months. And then a financial investor came knocking on the door, and he wanted to consolidate the hosting market. They needed also an acquisition in the Swiss market to complete their portfolio. And the good thing was we had good results in the books due to the pandemic that helped the hosting business. And so we closed this deal with these financial investors within 3 months, which is fast, but it's not uncommon for good deals that they go relatively quickly. And it only happened because we were just ready to take advantage of the opportunity when it presented itself. So it's also good when you think about selling, thinking about the time frame where you could sell your company, and then be ready to take also the chance of that the opportunity offers. This was a case where we sold basically more or less at the exact time.
Brilliant.
Peter, I have a very quick story on that, and it shows why in our business, I'm sure everybody here has heard the term time kills deals. That's why you want to prepare, because the better you prepare, the shorter the time you have to be on the market and the less exposure you have to all sorts of risk. And I will give you the best example I can think of why you move processes along, get them closed. We sold a steel distributor, a company that distributed structural steel, and we closed it on August the 31st of 2001. 11 days later, the world changed. And 6 months later, that company unfortunately was in bankruptcy because construction just shut down, as you know, in the US. So once you decide to sell, you want to be prepared and move as quickly as you can, and that limits the risk and exposure.
Brilliant. Thanks, Don. I've also got a great example in terms of when the company was sold at just the right time. It was a Christmas crackers business, bizarrely. So Christmas crackers might be a very English concept. So Christmas crackers are things you pull with fellow guests over Christmas dinner, and inside you have terrible jokes, silly hats, gifts, and so on. But this was a very successful business, and we sold it to a private equity house. And then within 6 months, that business was bust, because what happened thereafter was a Chinese competitor came into the market, and it took 2 of their major customers, supermarket customers, and as I said, the business was bust. Did our client know about the fact that the Chinese competitor may have come into the market? I suspect absolutely. Did the purchaser? Absolutely not. But it's caveat emptor. It's the purchaser's responsibility to do their own due diligence. But the point was here was that if you are aware of a category killer like an Amazon, they are about to come into your market and kind of eat your lunch, destroy your business, that is a really good time to sell. So you have to be flexible, and you have to have regard to what's going on in the marketplace, in the M&A market, in your own market, and react accordingly. Do not have kind of set ideas about, I'm going to exit in 3 years' time, and that's that. You need to kind of react to a whole series of kind of external events. Another example, I had a client that came to us. It was a photo library business, and it was increasing its bottom line by about 30% a year. The client said, or potential client said, look, I'm going to grow the business for another 3 years, probably 30 or 40% bottom line, and then I want to come back to you, and I want you to sell our business for a knockout valuation. We said to that client, you should be selling now, because in your sector, there's a bit of a valuation bubble, with really high prices being paid in your sector. It was kind of 5 to 6 times revenue, not EBITDA, revenue. That won't last. With every valuation bubble, they ultimately burst. So the client ignored our advice, did come back in 3 years, had increased the bottom line by around 30 or 40% a year. And we had to tell that client that the business was worth half what it was when he first came to us 3 years ago, notwithstanding the fact that he'd increased profits significantly, but the multiple had fallen. And valuation is a function of two factors. One is your own profitability, and the second is the multiple, which is largely determined by the market. And you cannot run your business with blinkers on and, as I said, have no regard to external events, to what's happening in the M&A world, because that is what determines your valuation ultimately, not just your profitability.
I maybe can share a counter case. We had a sales side mandate for a privately owned industrial machinery company in Germany. They do about 100 million in revenues, had production sites in several continents, and the private owners wanted to sell it. And we had a very nice American buyer who was a strategic buyer backed by a private equity company. The strategic buyer was about 15 times as large as our client, and there were good synergies. But we agreed about a purchase price, and then the due diligence was supposed to start, and our client decided to go on a 2-month sailing trip during that process. And because of that, the due diligence was not completed within 2 months. And when he came back, Corona started, and the buyer had to close down, at least for a certain period of time, 3 of his factories all over the world, and said, sorry, I cannot continue with this transaction. And so he dropped out. And a half year later, when he was back in business, the private equity owner decided to sell the business. So the deal was dead. So that is what can happen if you don't really concentrate on your transaction when you have gone to market, and really put all the efforts in one basket to secure a closing.
Brilliant. Thanks, Florian.
I read a business philosopher one time said the way you get rich is by selling too soon. Of 25 timing mistakes we see, 24 are waiting too late.
Mm-hmm.
Yeah, there are always reasons, aren't there, to put off a sale, but often they are the wrong reasons.
Right.
And tragically, we've seen so many cases of value being destroyed by people who've waited too long. It's a really good point. Next question we've got, does the size of your business matter on an exit? I'll take that one initially, and absolutely it does. So as your business grows in size and your profits increase, not only do you get a higher valuation due to the fact that your profits are higher, but you will also get a higher multiple applied to that profit stream. And certainly the figures in Europe show that for companies less than 5 million in value, the average EBITDA multiple is around kind of 5 to 6 times. Whereas when you get over, say, 500 million, 500 million, the EBITDA multiple on average is around double that. So it's around 12 to 13 times. And the increase between those 2 points is pretty much kind of linear. And why is that the case? Well, the fact is that as you get bigger, more buyers come into play in terms of both, the private equity community and crucially, in our case, overseas purchasers, because overseas purchasers, typically pay a significant premium to local buyers. So on average, we see, 1 or 2 times additional on the EBITDA multiple paid by overseas, particularly US purchasers. Hugely significant. And what I'd say is that, size and critical mass is only one factor, but it's a hugely important one. But clearly, I love to see entrepreneurs striving for a kind of $1 billion valuation unicorn status. But as Don said, you have to have regard to the risks in terms of what could, destroy value overnight. It could be a black swan event like COVID, for instance, we've seen recently. And COVID just goes to show, how important it is, as a factor in terms of maximizing the value of your business in terms of from a timing perspective. We've got some more questions come through. We've got an interesting one on AI. How it was just quite topical. How could AI affect the exit process currently or in the future in terms of finding buyers or any other aspect of the sale process? Will we all, my fellow panelists, be replaced by robots in the future? Who wants to take that question? Are you seeing, Don, are you seeing in the States any use of AI at all in terms of, say,
yeah, we do, Peter. In fact, we've used ChatGPT here for, beginning to use it for various things in helping us at least get a place to start. For example, we are searching for a new position in our business, and I went to ChatGPT and said, give me a job description for chief operating officer for an investment bank. And I got an almost perfect description. We changed one factor and used it. It was really good. Where I see the threat for AI, there are going to be a lot of them, but it's like automation. If you do anything that's repetitive or rules-based, you run the risk of being replaced by AI. We're already seeing this, for example, in tax returns. Accounting firms already use tax packages and those are really AI packages. Think about it, they're kind of rudimentary AI, but what are computers good at? They're good at following rules. What it's a tax code, it's a lot of rules. So if you have a business based on any concept like that, where you have rules-based, repetitive activities, I think AI is going to be a threat to your business.
I believe specifically in the sales process, there are certain elements that probably could be replaced, like parts of the information memorandum could be written by AI. Maybe some initial long lists could be generated with artificial intelligence. But if that is done by artificial intelligence, we as the advisor, we need to understand the company really in depth. And if we do this work not ourselves anymore, we will not get to the level of depth that we need later in the transaction. So there could be a potential benefit to automate the process, but there's also a potential risk for us.
Okay, a few more questions have come in. So what happens if, despite careful analysis and doing all the things we've talked about today, it transpires that actually the timing is not right after all? what action should you take? You may have launched the process, and come to that realization. What do you do?
I can take that because I recently had this experience in one of my projects. The company was really outperforming in this year, and the buyers were not willing to accept this as a basis for a new valuation, and therefore our client, a corporate client, pulled the process and said, okay, I've gotten a lot of feedback from potential buyers why they see the valuation lower, and I will use the next 18 months to amend the operations of my business accordingly, and then I will go back to market. But it's important that you need a certain time gap before you go to the market again. You cannot do it 6 months later again if you have already approached a number of bidders and come back to them. So I would say at least 15, 18, 24 months of gap is needed, and you really need to improve the operations or the critical items which were claimed by the potential buyers in the first round.
Brilliant.
And if the economic cycle moves against you, it can be longer than that. I mean, we've seen that in the building materials. A lot of
it's not risk-free. It's not risk-free to take that route. Yeah.
Yeah,
right.
A lot of owners decided to wait. You know, they were making a lot of money, never made that much before. Why should I sell now? Things turned down. And so one is they've already approached buyers, as Florian said. So you don't want to go back to them in 3 months or 6 months. So not only do they have that factor, they've got the economic cycle. So it's going to be, if they want to wait until the cycle comes back, it's going to be 3 to 5 years.
For sure. Yeah, absolutely. Great advice. Next question. We're talking about a situation of a strategic sale with a company with some great IP or technology first mover advantage. How do you minimize the risk of engaging future competitors, so creating future competitors as a result of disclosing that technology? And how do you determine whether the buyers are serious or not? What's the best advice to select a narrow target list up front and minimize the risk of that kind of phishing exercise or technology leak to competitors?
I can start that. I think it's important to make a correct selection of potential buyers, especially in a competitive process. Select those who are big enough to acquire the company, those who are acquisitive, so that grow through acquisition, and always trying to maintain the confidentiality of sensitive information until the right time to disclose it. Of course, it's not easy to do that, because at certain point of time you have to disclose the information, but the right time to disclose is very, very important. So actually having more than one potential buyer certainly gives us more negotiating power, and this usually reflects in higher valuations. But the important thing about a competitive process is to have a very coordinated process from the beginning, and of course taking care of sensitive information. In this case of the question about technology, until the right time to disclose it. And our work as financial advisor is to of course take care about this part of confidentiality through the whole process.
Brilliant, thanks, Priscilla. And actually this question is kind of related to what you just said there. What are your thoughts on negotiating with multiple acquirers at the same time, as opposed to, say, a rifle shot exercise where you've been approached by a party and you think you want to negotiate directly with them? What are the positives and negatives of each? Priscilla, do you want to kind of follow through with what you're talking about there?
Yeah. Actually, we always see a lot of value in a competitive process. We always say that a good process usually involves more than one potential buyer, if we can do that. Again, our work is to bring different options to the entrepreneurs. So they can compare not only valuation, but also have different transaction structures to think about what is the best option to follow. And having more than one potential buyer gives us more negotiating power that reflects in higher valuation. So it's a very good thing to have. When you have more than one potential buyer, it's very good. So the important thing is to make a very coordinated process, to take advantage of these competitions through the process.
Brilliant. Thanks, Priscilla. So I think guys, our time is up. So let me just wrap up. A big thank you to all of our panelists today, and thanks to everyone who's attended this webinar. I hope that everyone has got some good takeaways from it. As I said, this webinar is one of a series on exit planning. Our next one is on the 25th of May, same time. And that's all about the very important topic of how to maximize the price you achieve for your business on a sale. So hope to see you then. Until then, thanks everyone.